Welcome to the Capitalist versus Consumers Weekly Breakdown, your Friday after the close recap of everything that moved the market this week, what it means for your money, and what to watch in the weeks ahead. This video is for educational purposes only and not financial advice. Please hit the like button and subscribe so you never miss our weekly breakdown every Friday after the close and our daily after the bell report every trading day. Let's get into it. The week in numbers. Let's start with where everything finished. The S&P 500 closed Friday at 7,230, hitting a fresh all-time high and closing above 7,200 for the first time in history. For the month of April, the S&P 500 delivered its second-best monthly performance on record. That is an extraordinary statement given everything that happened this month: a war in the Middle East, oil above $100, record low consumer sentiment, and one of the most uncertain geopolitical environments in years. The Nasdaq also closed at an all-time high Friday at 25,114, surpassing the 25,000 level for the first time ever. The Dow finished at 49,499, just 501 points shy of the historic 50,000 threshold. The Russell 2000 Small Cap Index closed at 2,812, continuing to lag the large cap indexes, but showing improving momentum late in the week. Bottom line, this was one of the strongest weeks of the year for financial markets, and the month of April overall was historic. The 5 stories that defined this week. This was one of the most eventful weeks in recent market history. 5 major stories drove every single trading session, and every investor needs to understand all 5. Story number 1. The Magnificent 5 earnings. The defining event of the week was Wednesday night's simultaneous earnings reports from Microsoft, Alphabet, Amazon, and Meta, followed by Apple on Thursday night. These 5 companies represent roughly 1/3 of the S&P 500's gains since March, and their results either validate or challenge the entire AI investment thesis. Here is the scorecard. Alphabet was the undisputed winner. Google Cloud revenue grew 63% year over year, dramatically above the 48% delivered last quarter and well above what analysts expected. The cloud backlog nearly doubled in a single quarter to $462 billion. Alphabet surged nearly 9% on Thursday, hitting an all-time high. Its market cap doubled to $4.4 trillion in a single year. That is one of the most remarkable corporate performances in market history. Amazon delivered strong results with AWS growing 28%, the fastest growth in 15 quarters. Revenue beat estimates by over $4 billion. Net income nearly doubled. Amazon shares rose approximately 4%. Microsoft beat on revenue and earnings. Azure grew nearly 40%, above guidance. AI revenue reached a $37 billion annual run rate, up 123% year over year. And yet Microsoft fell 4 to 5% because it raised full-year capital expenditure guidance to $190 billion. Strong results punished for big spending. Meta beat dramatically on both revenue and earnings. 33% revenue growth, earnings per share nearly $4 above estimates. And yet Meta fell 9%, its worst day since October, because it raised capital expenditure guidance to $125 to $145 billion, and user growth disappointed slightly. Apple closed out the week on Thursday night with a strong quarter. Revenue of $111.2 billion beat estimates. Earnings per share of $2.01 beat estimates of $1.96. Services revenue of $30.98 billion set a new record. Gross margin hit an all-time record of 49.3%. Apple shares rose more than 3% on Friday. CEO Tim Cook cited extraordinary demand for the iPhone 17 lineup. Incoming CEO John Ternus joined the earnings call and was introduced, a smooth transition signal that the market appreciated. The overall verdict from earnings week: AI spending is real, and the returns are starting to show up most clearly at Alphabet and Amazon. The market is getting more selective about rewarding that spending. Companies that can demonstrate the returns get rewarded. Companies that raise spending without equivalent visible returns get sold. That is the new standard for big tech in 2026. Story number 2, the Federal Reserve and Jerome Powell. Wednesday afternoon, the Federal Reserve held rates unchanged, exactly as expected. But two things happened that will define monetary policy for the coming months. First, Jerome Powell delivered a message that was clearly hawkish. With oil above $100 and inflation concerns real, Powell said the Fed is in a position to wait and see how conditions develop. That is Fed language for, do not expect rate cuts anytime soon. The market had hoped for clearer signals about cuts later this year. It did not get them. Second, and this was the surprise of the week, Powell announced he will not resign from the Federal Reserve Board of Governors when his term as chair ends in May. He will remain as a regular governor. That means incoming chair Kevin Warsh, who cleared the Senate Banking Committee in a party line vote of 13-11 this week, will have Powell sitting at the same table, potentially pushing back on rate decisions. This creates an unprecedented dynamic in Fed history. Watch this relationship closely. If Warsh and Powell disagree on rate decisions publicly, that internal tension could itself become a market-moving story. Story number 3, oil and Iran. Oil was the dominant macro story all week, and it remains unresolved. Early in the week, oil briefly crossed $100 a barrel, the first time since the early days of the conflict. Gas prices hit $4.17 per gallon nationally, the highest since August 2022. The Strait of Hormuz remains effectively closed. Iran put forward multiple proposals to reopen the strait. The United States rejected each one, primarily because the proposals delayed nuclear concessions. President Trump maintained the naval blockade and said this week that only he and a handful of others know the true status of negotiations, suggesting quiet diplomatic progress happening behind the scenes. Oil pulled back late in the week on reports of incremental progress toward a framework agreement, ending Friday around $102 per barrel, off the highs, but still elevated. Here is why this matters for your investment portfolio. Every dollar oil stays above 80 keeps inflation elevated. Elevated inflation keeps the Fed cautious. A cautious Fed means higher rates for longer. Higher rates for longer puts pressure on growth stocks and makes borrowing expensive. The Iran situation is not just a geopolitical story. It is a monetary policy story and a stock market story simultaneously. Story number 4, the OpenAI lawsuit. Tuesday, a Wall Street Journal report stated that OpenAI missed its internal revenue and user targets, sending AI stocks into a broad sell-off. That sell-off happened on the same day that Elon Musk took the stand in his federal lawsuit against OpenAI in Oakland, California. Musk is suing for $134 billion and wants OpenAI forced back to nonprofit status with Sam Altman and Greg Brockman removed. OpenAI says Musk is a bitter former co-founder trying to kneecap a competitor after leaving the company in 2018 and launching his own AI venture xAI. The trial is expected to last 3 weeks. The stakes could not be higher. A Musk victory derails OpenAI's planned IPO, potentially worth hundreds of billions, and creates serious legal exposure for Microsoft, which is named as a co-defendant. An OpenAI victory validates the company's trajectory and clears the path for one of the most anticipated public offerings in history. This trial will be a recurring story throughout May. Watch it closely. Story number 5, the broader market picture. Beyond the individual stories, there are several broader market data points worth understanding as we enter May. First quarter earnings season has been exceptional, with nearly 60% of S&P 500 companies having reported S&P 500 earnings are now expected to grow 14% year over year, up from estimates of 12% at the end of March. Full year 2026 earnings are projected to rise 18.7%, well above the 15% expected at the start of the year. Wall Street analysts have a median year-end target for the S&P 500 of 7,650, implying roughly 6% additional upside from Friday's close. The most bullish forecasts are even higher. Consumer sentiment remains at record lows, People feel worse about the economy than at any point in survey history. But actual consumer behavior tells a different story. Visa reported 17% revenue growth this week. Starbucks beat estimates. Amazon's revenue beat by $4 billion. Consumers are still spending. Gold hit $4,621 per ounce this week, a new record. Bitcoin is trading around $78,000. Both reflect a broader environment where investors are seeking stores of value amid geopolitical uncertainty and a declining US dollar. What to watch in the week ahead? May is historically a strong month for the market. The S&P 500 averages about 0.9% gains in May, with positive returns roughly 68% of the time. The Iran situation remains the single biggest wild card. Any credible progress toward reopening the Strait of Hormuz would be a massive positive catalyst. Lower oil, lower inflation, more room for the Fed to cut. Any escalation goes the other way. The Musk versus OpenAI trial continues, and any major developments will move AI stocks. Kevin Warsh's full Senate confirmation vote is expected soon. His first actions as Fed chair and his relationship with Powell, who is staying on the board, will be closely watched. Earnings season continues with several major companies still to report. Watch for any commentary about consumer spending trends. With sentiment at record lows, the question of whether that eventually shows up in actual spending data is the most important economic question of the moment. The bottom line for everyday investors this week delivered an extraordinary amount of information, and the overall picture is more positive than negative. Earnings are strong. The AI build-out is generating real returns, most clearly at Alphabet and Amazon. Apple demonstrated that the iPhone 17 cycle remains robust, and its record gross margins show exceptional business health. The market hit all-time highs despite oil above $100 a war in the Middle East and record low consumer sentiment. The risks are real, but they are known. Oil and Iran. Fed policy under a new chair. AI spending sustainability. The gap between consumer sentiment and actual spending. None of these are new this week. All of them were present at the start of the week, and the market still delivered record highs. For long-term investors, the message this week is the same as it always is. Stay diversified. Stay consistent. Let the earnings growth compound over time. Do not make reactive decisions based on any single week's headlines, even a week as dramatic as this one. April was the second best month for the S&P 500 on record. May is historically positive, and earnings are growing faster than expected. That is a strong foundation for patient long-term investors. That is your weekly breakdown here at Capitalists versus Consumers for the week of April 28th through May 1st, 2026. Please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell report every single trading day. We will see you Monday at the closing bell. Recommended reading for investors: The Psychology of Money by Morgan Housel, The Little Book of Common Sense, Investing by John Bogle, A Random Walk Down Wall Street by Burton Malkiel. This video contains affiliate links. I may earn a small commission at no extra cost to you.